Hi everyone, Somi here from InPeak with another episode of Investor of the Day. Every Monday to Friday, we bring you an angel investor, a family office, or a VC who shares their investment thesis so that you know what they're looking for. Today, we are featuring Cara Morphew from Sweat Ventures. They're a seed and Series A investor from Colorado who primarily invests in consumer tech, health tech, fintech, SaaS, and AI.
So Sweater's investment thesis is we invest in technology and consumer startups with a focus on investing in companies that are kind of community driven. So what I mean by that is companies that we can share with our large investor base of thousands of investors, and they're incentivized to not only use those products or services themselves, but also share with their networks. And then the other part of our thesis is we focus on investing in seed and Series A startups. Usually our check size is about $250,000 to $750,000. We don't typically take lead positions. We'll sometimes co-lead, but usually we're participating as a co-investor alongside a larger lead. A common trait that I typically look for in founders is resilient resourcefulness. So what I mean by that is investing in founders who can adapt to different things that come at them and different challenges and obstacles that they might encounter as a founder of an early stage startup. Obviously, a lot of different things will happen and uncertainty will hit you, especially with like different types of market conditions. And so it's important to understand as a founder how to utilize people and resources around you and adapt and find creative solutions when necessary. A deal breaker for me when evaluating a startup is a founder who doesn't treat their team with respect. So ultimately we'll end up doing a variety of diligence calls on the founders that we're looking to invest in, utilizing former colleagues of theirs or mutual connections that we might have with the founders, and understanding a little bit more about who they are and how they work with others on their team. And if we hear some feedback that is questionable in terms of how they treat their teammates or employees, that's obviously a huge red flag to us. Ultimately, if we hear of anything that's even further like a harassment claim or a lawsuit or anything like that, then that's an immediate no for us. We have zero tolerance for that. So it's just really, at the early stages, obviously really understanding how a founder works is tremendously important, because there's not a whole lot of concrete data in terms of financials or historicals at that point yet. So it's really important to assess the team and understand who they are as a person beyond just their initial pitch. The one piece of advice I would give to founders is to remember to take time and focus on your mental health. Burnout is very real, and a lot of founders end up going through it if they kind of forget to take time to recharge and think about what they need in their life. And everybody does it in a different way. It might be, just taking a little bit of time to work out or spend time with family or rest in your day. But ultimately, if you do kind of consistently take that time and remember to focus on your mental health when necessary, that will ultimately lead to, more efficient and effective work when you are focused and heads down. Startup exit strategy is important enough where I want to know that, especially like at the seed Series A stage, I want to know that it's something that the founder has thought through, and there's options that they've gone through in terms of potential exit strategies. Though I will say, like, I won't expect for them to have a super detailed plan of exactly how it will all go down, because in those early stages you never really know what's going to happen, and there might be a few different paths to exit. But ultimately what it comes down to for us is understanding what the fundraising plan is in the future, like how much a founder plans to take on in funding, and then what their exit plan is according to that fundraising plan. So for like consumer product startups, they might not raise as much money. They might only be bringing in, one or two small rounds of funding. So if their plan is to exit at like $100 to $200 million, then that's a pretty awesome outcome for a startup who's brought on, minimal funding. it's still very lucrative with high multiples for the investors involved. But if I'm looking at a technology company that requires, substantially more funding and multiple rounds of funding, or early stage investors likely will get diluted down, then I need to understand that they are gunning for, multi-billion-dollar exit opportunities, just to make sure that the multiple will be worth it and it makes sense from an ROI standpoint for an investor. Typically, after a pitch or at the end of the pitch, I'll save a couple minutes for us to talk about kind of next steps. And usually I'll go through it then, but ultimately I'll have, a couple of questions. Maybe it's sending the data room or a more detailed deck, and that will be kind of the follow-up action items for the founder. So I'll usually expect that they'll shoot that over via email after the pitch. And then ultimately, once we have a little bit more time to dig in, then we'll follow up. If we decide to go into deeper diligence, we'll follow up with more questions via email, and kind of go back and forth after that. Usually if we get further along in the diligence process, then I'll grab their phone number and we might be texting or doing some more casual calls once we're pretty deep in the diligence process. But typically I'll ask that they follow up via email with any of the materials that we mentioned at the end of the initial pitch.
I hope you enjoyed today's episode of Investor of the Day. Make sure to join us at InPeak.xyz, where we have daily live webinars, masterclasses, panels, and networking opportunities. We now also have a forum where you can hang out with other founders and investors and build your network.